Absolutely. That 3.5 coming on the heels of that 4.2, getting us to right at 3, even for the trailing fourth quarters is being very well received here, as you can imagine. It's exactly what we told people we were shooting for, that sustained 3% growth. So it's nice to see the policy changes that the Trump administration has put into place paying dividends for the American people.
Given that kind of growth, Mick, why is the president demanding that Jay Powell stop raising rates? It would seem to me we have a fairly strong economy and one in which you'd expect the Fed to continue on its course.
Sure, and we've had this discussion before, I think, on this program about demand-driven growth versus supply-driven growth. One of the things you see in the other numbers that came out today is that not only are we at 3.5 and 3.0 on the trailing 4 quarters, but inflation has actually ticked down a little bit. I think the adjustment was 1.6% on an annualized basis. So we're seeing this sustained level of growth without what the Fed might typically expect to see in inflation. And that's what we've told people to expect in a supply-driven market, which is where we think we are. So I think the president's absolutely right to raise that issue, both with the Fed and generally. A lot of other economists are talking about it as well. We do not see that inflation, and therefore a little bit surprised that maybe the Fed is pushing as if we're in a demand-driven cycle.
Well, Mick, speaking of supply-driven growth, when inventories add more than 2 percentage points to the GDP number, I mean, that's supply-driven, even though consumption was good. You have to be hoping those goods get bought in the quarters to come.
Absolutely we do, which is why it's so nice to see not only the consumption side up, but also, again, going deeper down into the data, the household income up, the GDP per person going up. The fundamentals are all there for this being a sustainable type of growth. So, yeah, we do watch those inventory levels. Keep in mind, while they did help the GDP this quarter, they actually dramatically hurt GDP by about, I think, 90 basis points in the last quarter. So it's very volatile, but we do watch that. But, again, all the fundamentals point to this being sustainable for at least the near term.
How's it going to impact the debt? I mean, Director Mulvaney, you guys told us 1,000,000 times that the tax cuts are going to pay for themselves through economic growth. Yes, we're seeing higher economic growth, but we're also seeing a budget deficit that just swelled by about $800 billion, 17% in 2018, and on track to surpass $1 trillion. Why isn't it happening?
Sure. Well, a couple things actually are happening. Number one, revenues are up. I think we took in record revenues last quarter, number one. We've also seen that the long-term trends on our growth lines are going to help us with our deficit. Keep in mind the deficit, even though it was higher than anybody would like to see, was at I think 8 and change, was $70 billion less than the Congressional Budget Office expected just in July. So the revenue numbers for the government are there. It's the spending side of the ledger that we think is driving a lot of the deficit. And it's not even necessarily mandatory spending. It's discretionary decisions that we've made aside from the taxes that are hurting on the spending side. So it's one of the reasons you heard the president talk last week at the cabinet meeting about the nickel plan to get discretionary spending under control. The deficit is important. The president is aware of it. He is concerned about it. And he's going to do everything that we can from our side of town here to try and get spending under control.
Well, there was a significant increase as well in the defense budget, Mr. Mulvaney, which has contributed to that as well. I'd love to get back to the sustainability question, because you've heard it, I'm sure, if you watch our air. Many of the economists or strategists who come on talk about the sugar high, tax cuts, and this much larger budget we got last year. We're going to anniversary it and get back to that 2% roughly GDP growth we became accustomed to. What do you see that you believe is truly sustainable? Give us a little bit more granularity.
Yeah, there's a lot of folks, I think, heavily invested in seeing us get back to 1.9%, because at the end of the outgoing administration, they were the folks who said that was the new normal, that you could never get to 3%. My favorite line, I think, is Paul Krugman saying we could make him complete dictator of the country, and he couldn't get us but a couple tenths of a percentage point on GDP. That's how locked in some folks on the other side of the political spectrum are, that 1.92% growth. Here's why we don't think it's a sugar high. Yeah, we reduced rates. There's no question that helps people. It really does. Bonuses and wage increases help people. But it's that capital investment long term. The way that we have changed the way we tax capital in this country, not only by lowering the corporate rate, but also by giving that immediate deductibility for many capital expenses. That is a long-term payoff, and it's why we do not think this is a sugar high. And when we say the fundamentals are strong, that's what we're talking about.
Yesterday, Mick, Greenspan goes on NPR and says that the impact of the tax cuts has largely run its course. Yesterday, Mester, voting member, says higher long-term growth rate from fiscal policy is unlikely. What are they missing?
I think they're missing the granularity of the tax cuts. Again, what we've done, we didn't do what President Bush did. We didn't just lower marginal rates. We fundamentally changed the way we tax wealth creation. And by encouraging businesses to reinvest in themselves, again, saying, look, in the past, if you made $100, we tax you on that $100, and then you had that available to reinvest in your business. Now we're saying, look, take the $100, invest it in your business, and we won't tax that at all. That is a fundamental change to the way businesses operate. It's why we think, again, the capital investment numbers are a little bit flat this quarter, which we're a little surprised to see. But over the course of the last several quarters, that capital investment number has been fantastic. Business confidence at all-time high. Businesses are investing in themselves again, and that's the long-term payoff. You get a short-term bump to GDP when they buy that machine, but a long-term bump to GDP when that machine actually comes online and starts producing something.
Although, Director Mulvaney, the market is down 7% in the month of October. Is the administration getting worried about the depth of this sell-off? And is there any discussion of changing policy or posture around trade, which is clearly a source of anxiety for this market?
A couple things on that. I mean, October is traditionally a rough month for the stock market. I think you all did a special on that a couple of weeks back. So we're not too concerned about it. Again, the fundamentals are strong. And we think that's ultimately going to drive long-term valuations in equities. When we talk about some of the other things that are happening in the economy, everything seems to be pointing to more sustainability in this growth rate. So, yeah, stock market's going to go up and down, and certainly we do follow it, but we don't use it sort of as an indicator of where we're headed.